All right. Thank you. Welcome to this March 15th special board meeting of the West Linn-Wilsonville School District. There are two items on our agenda. One has to do with PERS bonding, and it's kind of a learning opportunity for us. And then if it's something that we're interested in pursuing, then we as a board can have that discussion and reach a conclusion on that. You will also notice that we added another item to the agenda. We noticed it on Friday, and it came before us. It had to do with a construction project, and it's time sensitive in that we as a board need to approve it. To the extent that when we get to that agenda item, I'll then quiz the board on what they need in order to be able to proceed on that today, or we can push that agenda item to another day later this week. So we've got some flexibility there, but if we were at all able to be prepared to handle it today, it has been properly noticed so that we as a board could do that. All right. So beginning, we have Dr. Hughes as well as Carol Samuels here with us and Brendan Watkins to walk us through a presentation with regards to pension obligation bonds. And I would just ask that when anybody is speaking on that, I noticed just in the PowerPoint, there's a lot of acronyms. And to the extent that we're going over those for the first time, just to make sure that those of us who have a more lay knowledge of financial matters understand what that means and indicates. All right, and then with that, I will turn this over to Dr. Hughes. Do you want to get us started?
Yes. Good afternoon, everyone. It's so nice seeing you all today. So we have Carol Samuels and Brendan from Piper Sandler join us today. Carol and Brendan will present to us the detailed information on the pension bond. So Carol and Brendan, the memo that I shared with you last week, that is a memo that I provide to our board on this meeting. So in that memo, we just focus on general information about the history of the pension bond that West Linn-Wilsonville have in 2004, and then the current UAL that our district have, and then the current PER rate for the biennium 21-23. In the bottom of that memo, I just have a very general information about the pension bond workshop that you had for us on March 2nd. So with that, we are really eager to learn more in detail about pension bond this afternoon with you. So you have the stage.
Okay, well, good afternoon, everybody. It's nice to see all of you again. I am going, Curtis, I have the ability to share, right?
I believe so, yes.
Okay, so let me bring it up. Can everybody see the PowerPoint? Excellent. Well, let me put it in presentation.
Carol, I'm just going to interject real quickly too. As you're going through this presentation, will you please pause periodically so that if there are questions, then we can ask those. Okay, thank you.
Absolutely. And let me just emphasize that this is a complicated topic. It's also one that is unlike any other borrowing that the district has entered into previously, other than your past pension bond. And I don't believe any of you were on the board back in 2004. So what you need to understand on this journey is this is not like your general obligation bonds or other smaller scale borrowings you've done. So please do take advantage when I pause of any questions you might have. And furthermore, if I haven't paused and you have a question, don't hesitate to interrupt me, because I think my main goal is that you have a pretty deep understanding of what this looks like before you make a decision. So with that, I think there is a chat item, so let me just check that. We cannot start. So the question was, can we start with what my recommendation is? And this may be a frustrating response, but the truth is I don't give recommendations on this subject, largely because we stand to benefit financially from your participation or lack thereof. And so I am here to present the facts as I know them, and then we'll leave it to you to determine whether or not this factual data is comfortable enough to proceed. So we can come back to that, but one thing I would say as I'm going through this, if someone, maybe Brendan, could monitor the chat and let me know. This group is not super huge, so I would actually encourage people to just speak up if you have questions. But
So Carol,
yes.
I have a question. So because we do have the financial advisor, so I can, after the presentation, and I think without more question about the recommendation, we can have a quick meeting with our financial advisor on that.
Correct.
Yeah, so if that possible, would you share a little bit about the financial advisor that sent out the information that Chris sent out a few days ago?
Yes,
okay.
I will.
Thanks.
Okay. All right. So what are pension bonds and why are we talking about them? Well, pension bonds, also known as pension obligation bonds or POBs, are available to help potentially reduce the costs associated with paying for your pensions. The concept is to borrow at low interest rates, take the money, send it to PERS. PERS will then invest it in a special account known as a side account. It's kind of like your own savings account. And if they earn over the course of approximately 20 years more than your borrowing costs, you save money. So I will note that there is a lot of noise. There are a lot of technical details about PERS and about the PERS system and the different tiers and the assumed rate, et cetera, et cetera. I would encourage you to focus on the simple soundbite that I just uttered, because in effect, that's the main deal. If you can borrow at a lower rate, then it is invested and returned, you will save money. If you can't, if you borrow at whatever interest rate you lock in and you send it to PERS and they earn less, then you stand in a position where you are in worse shape than you would be if you did nothing. We'll go into more detail about that, but fundamentally, that's the deal. So, as I said, bond funds are deposited into this special side account and invested with the rest of the PERS fund. Any earnings or losses are credited directly to the side account, which I've referred to here as an SA. The side account is amortized over approximately 20 years, meaning that PERS comes up with a drawdown schedule over an extended period, and they take out a certain amount each year, and that amount is credited against your payroll rates. It's called a rate credit, and it is used to reduce the payroll rate percentage that you would otherwise pay. Because this is not a capital borrowing, under federal tax law, you have to sell these bonds on a taxable basis. And the district has some experience with taxable borrowings. That's how we've done refinancings recently. But what that means is that the interest rate is somewhat higher than it otherwise would be if you could do it on a tax exempt basis. So that's a factor in determining what the cost of capital is. One other side note, I think you guys may have talked about making a deposit to a side account last year when the state was running a special matching program called the Employer Incentive Fund, where they would match up to 25% as long as they had money of the deposit you made. Not only is that money non-existent, the fund has been depleted, but one important note is that borrowed funds are not eligible for a state match. That was only available for cash. So let me pause there and see if there are any questions.
So I just want to refresh us about the side account that Carol just mentioned with the 25% match from the last year. That is, we cannot borrow money to do this side account. We must have cash in order to qualify for the 25% match. I don't know if you need Carol to go a little bit further. And since last year, we did not make the decision because we did not have any extra money to participate. So that option to us is no longer available.
All right, and then I'm also noticing that board members had some wondering about, it sounds like the potential financial interests of Piper and what that means. So can somebody elaborate for us, please, on if there's a conflict of interest or how we would weigh the information we're receiving today?
So what I would suggest, everyone, I'm happy to talk about that now, but I think it might be clearer when I get to how this whole transaction might evolve to talk about what our role would be. Is it okay if I wait to address that in a bit?
I really want to know before I'm considering the information you're giving me, what your interest is. You hedged on your representation that it could hurt or benefit Piper Jaffray. I want to know how much and whether it hurts or benefits, whether we take this action. And in addition to what Dr. Hughes was saying, my understanding is that we have not done the side account. So some of this information, I think we need to know that that doesn't apply to us. And so if I'm misunderstanding that, someone correct me on that as well.
Okay. So what we are talking about here is the potential for the district to sell bonds. Our proposal, if you want to move forward, is that you would retain Piper to sell the bonds for you. As such, we stand to benefit if you decide you want to move ahead. Because this is a fairly risky transaction for you, I do not feel it is appropriate for me to make a recommendation as to whether you proceed or you don't proceed, because I think there is a potential conflict that theoretically I could make a recommendation that you proceed and then I benefit from that. So furthermore, I feel that, and I've been doing this for 20 plus years, that because there is risk here, I really think it is not my place to push you one direction or another. I think we have developed a trusting, what I hope is a trusting mutual relationship. And I really feel that this is a decision that each board member needs to make based on the information that's provided. Now, as Sun Lee has indicated, we also think it's prudent for you to hire a third party municipal advisor who may be in a better position to give you an actual recommendation.
And I would just note too for the board that the role of Piper in this is not too unsimilar to the role of when we were contemplating our 2019 bond and trying to receive information on what our bonding capacity is or would be, and the lifetime of the bond. They were also the entity that ultimately, when we received those bonds, that or approval of the bond, that helped us facilitate that process of our bonding process. So it's a role that they've played for us in the past, and we've invited them back to help us understand this role here today as well.
So Piper Jaffe stands to receive potentially how many thousands or how much millions of dollars if we were to go this rate? Can you give me a range? I still haven't got the answer to my question.
I apologize. I'm not trying to dodge how much we might make. We have not identified what
You have an idea?
Yes, I have an idea, but it really depends on how much you borrow. And also we've got a pooled group, and depending on how big the pool is, it may affect the overall pricing. Right now, we're thinking probably in the range of about 0.5% of what you borrow would be our fee. Again, that may be plus or minus depending on how large the pool might be.
I'm wondering if we go back to what Dr. Hughes mentioned, is that we do have a financial advisor. So if we consider this time to be purely a workshop to learn about how do pension bonds work and a review of how they function, and think of this as a workshop, not a decision, then we can have a meeting with our financial advisor around, you've had a workshop on pension bonds. Are there any other questions? Is this something you want to pursue as a board? It's our obligation when interest rates are low and the district has, you as a board have fiduciary responsibilities that you're charged to by the community, that when opportunities like this come forward, we need to present them to you. This workshop that you're hearing today was actually done for many school districts, and Carol agreed to do it just for us as an audience, so that there could be more interaction by board members. So again, this can be purely workshop, no decision or action made at the end of this, and then direct staff if you would like a meeting with our financial advisor to further process what you've learned and see if this is something you're interested in pursuing as a board.
Okay.
Chair Molitor, do you want us to continue or?
Yep, I was just going to say, let's please continue.
All right. So why might you want to consider this? Well, right now, and you guys have seen variations of this graph before when we were looking at your general obligation bonds, but since then, interest rates have continued to decline, although in the past month, they've come up somewhat. But even so, relative to where you were in 2004, right around here, when you borrowed last, the inescapable conclusion is that interest rates, which is one very important side of the equation, are at significantly lower levels than they have been on average over the past 25 years. So that's something to be aware of. Oregon has a lot of history with pension obligation bonds, including for the district. Over 100 Oregon pension obligation bonds were sold between 99 and 18, with a total exceeding $6 billion. Interest rates ranged from a very low, this happened for one lucky borrower, of 3.43% back in 2015, to a high of over 7%, with an average of about 5.5%. And borrowing amounts range from a low of $3 million to the state of Oregon issuing $2 billion in pension obligation bonds. Most school districts and community colleges have borrowed on a pooled basis, and that's what we would propose here as well, where you enter into a pooled borrowing with other school districts. Right now, we have about 25 school districts that are considering doing this simultaneously. And the way we equalize everybody in the pool is that each district enters into an agreement with ODE whereby they intercept a sliver of your SSF appropriation each month and send the money directly to a trustee who holds it and makes the payment on behalf of all the districts within the pool. That levels the playing field between all borrowers, and you actually get a bond rating that is just one notch below the state of Oregon's, which is higher than what Linn-Wilsonville would get on its own. So it gives you economies of scale of borrowing all at the same time, does reduce the cost of issuance overall, and it also elevates the credit rating, so it's a win-win for sale purposes. The good news that helps me sleep at night is that generally positive returns since we started working on these borrowings means that most, including Linn-Wilsonville, have realized savings. But it's also important to know that not everybody has realized savings. We did do one pooled borrowing in 2007, right before the market crashed. And that group of 8 school districts have not realized savings. In fact, they are still in the hole, and barring a really strong set of returns over the next 7 years, they're likely to continue to be underwater. And I'm noting there are some questions, so let me read what those are. Okay. Yes, SSF is state school fund. And I see what you were saying, Regan, about not using acronyms. Apologies. So let me pause there, see if there are any questions.
Carol, it sounds like being in a pool has some advantages. You were talking about leveling the playing field and maybe getting a higher rating than going it alone. Are there any disadvantages to being in the pool, or does it reduce any risks?
So that's a really good question, Kathy, particularly since I think West Linn has a sufficiently strong credit rating that you could go on your own, unlike some districts. So it's a choice, and I don't want you guys to feel like you have to go this direction. I do think The main downside to going in the pool is it's going to take a little longer because we have to coordinate all of the districts, make sure they've all got the same documentation, have their boards approve it, et cetera, et cetera. So if you guys were raring to go and you wanted to go immediately, we might be able to do your issue faster. Nevertheless, and I am going to make a recommendation on this one, I think you would benefit from being in the pool because you are likely to get lower interest rates and lower costs. So.
Is it confidential information who is going out for a pension bond, the 25 school districts, knowing who they are?
No, I am happy to share. They are a pretty diverse group. In the metro area, Oregon City is on the list. Portland Public is thinking about it. Other districts of size, Springfield. And then we've got North Marion and LeGrand and several community colleges, Mount Hood Community College, Clackamas Community College, Chemeketa. So it's a pretty broad range. The smallest issuer we're talking to is North Powder. They're at about $4 million. The largest is PPS.
I think.
Yep. Okay, I'm going to move on then. So I've already said this multiple times, but I'm going to say it again. In using slightly different language, this is what's called an arbitrage play. In the world of municipal finance, the word arbitrage is generally a dirty word where you want to run because it's something that the federal government doesn't like. In this case, what we're talking about doing is borrowing money and hoping, gambling, if you want to call a spade, that you can make money on your borrowed money. So some people, that's called arbitrage, when you profit off of one market versus another market. Sometimes I've heard people refer to selling a pension bond as like refinancing a debt or refinancing your mortgage. And I want to tell you here and now that it is absolutely nothing like refinancing your GO bonds, which we did last year. Why? Because when you refinance your GO bonds, what you've done is you've locked in a new interest rate, and I can guarantee your savings on the day we close. In this case, it is true that you arguably have a debt at PERS, and PERS is charging you the assumed rate of 7.2%. But that's really kind of background noise, because let's assume you borrow, and we're right now assuming a borrowing rate of 3.5%, which is a ton lower than 7.2, no question. The thing is, though, when you borrow at 3.5, you're not paying off your 7.2% obligation and then walking away from it the way you would if you were refinancing your mortgage at 7.2 and borrowing new at 3.5. The problem is at PERS, your obligation doesn't go away. So let's assume you borrow at 3.5, and rather than earning 7.2, which is what the fund assumes, you earn 2.5. You're still responsible for the difference at PERS. So that's why using terminology like this is a refinancing or with an expectation that there's any guarantee is completely inappropriate in this case. It's a bet. And it might be a really good bet in this market, but it's still a bet. And you have to be comfortable with the fact that you may not know for years and years whether the bet paid off.
So Carol, can I ask a question for a second?
Yep.
So this is Christy Thompson.
Hi,
So
Christy.
hi, would you also is leverage just another word for arbitrage? Would you use those two interchangeably? Meaning you borrow money to invest in the stock market. And these questions, so my husband's in finance or in investments. So I had him, we spent a couple, 2-3 hours, and he just walked me through too. So I'm going to be honest and just say some of these questions come from just his finance knowledge, which is so much greater than mine.
Excellent.
So when he referred to this, he talked about leveraging, which he said is known kind of as risky. Of course, arbitrage is too. So is there a reason we call this arbitrage and not leverage? And is one less risky than the other? And maybe it doesn't matter, but I'm asking the question, but.
So all really good questions. To my mind, the word leverage just means borrowing.
Okay.
Whereas arbitrage is a concept about profit off of two different markets. This is a leveraged arbitrage play, if you want to use finance lingo. So arguably, if you had set up a side account with cash, that is also an arbitrage hope where you take the cash that might be sitting in a checking account somewhere earning less than 0.5% and you send it to PERS. So the arbitrage there would be between, if I can earn 0.5% in the local government pool, but if I send it to PERS, I might earn 6%. That's another kind of arbitrage play, if you will. But that arbitrage play is a little easier to not have anxiety about, just because over time, PERS has done much better on investing cash than the district has done. This idea introduces the concept of leverage, which is probably what your husband was talking about, where not only are you taking cash and giving it to PERS, but in order to access that cash, you have to borrow it. So then your baseline is not what you're investing it at, but what your borrowing cost is. So rather than the cash investment arbitrage being between, well, if I'm investing now at 0.5%, what are the odds that I'm going to earn more than that? Pretty darn good. In this case, it's I'm raising my benchmark to, if I borrow at 3.5, what are the odds I'm going to earn more than that?
Okay, thank you. And then my other question, or another question, and you can certainly answer this later if that's better. But one of my questions was going to be, do we know how PERS invest this money? How we're so we invest it with them, but they're using some sort of, what kind of transactions are they doing? How are we investing them?
So PERS has, as of last month, a portfolio valued at $80 billion, which makes it surprisingly, one of the larger public pension funds in the country. So as you might expect, they are broadly diversified and they invest in stocks and commodities and fixed income bonds. They also have about a third of their portfolio in what's called special equity, which is kind of leveraged buyouts and all kinds of exotic stuff that's handled privately. That is not my area of expertise. And one of the things the district did do was sign up for an assessment that I'm going to go over in a minute with Echo Northwest, who took a look at their asset allocation of what was in their overall portfolio to get a sense of whether the probability of success was high. So I think that's coming up on the next slide.
Okay, thank you. Because I was going to ask about who's Echo Northwest and who are they and what is this? So perfect, thank you.
You bet. Any other questions before we move on? Okay, so how do you judge whether this is a good risk or a bad risk? As I said, I'm an expert in borrowing, and I can tell you that one side of this equation, pretty good shape right now. What I can't tell you is the other side of the equation. That's just not where my expertise is. That said, I do have some data to share. One thing you could look at is PERS history of investments, and PERS has been a fund since the 1940s. And PERS itself is not responsible for investing the portfolio. The Oregon Investment Council, which is run by the state treasurer with a large number of investment advisors, is responsible for managing the investment of the PERS portfolio. And over the past 50 years, they have had a remarkably strong investment performance. So between 1970 and 2019, the fund earned over 10%. Side accounts since 2007, which includes that devastating 2008 year where the fund lost 27% of its portfolio. Despite that, they've recovered quite nicely and have a history of 7.6%. And in the last year alone, the fund has earned over 8%. So if history is a good guide, that should give you some comfort. However, when I went to business school, I was told that history is history. So it gives you comfort that this is a well-managed fund, but it is not forward-looking. So the district entered into a contract with Echo Northwest, which is a well-regarded economics consulting firm headquartered in Portland. And over the past 20 years, since we started working on pension bonds, Echo Northwest has done this analysis each time. And it's important to note, again, that the district entered into this agreement with all the other districts at a very nominal fee to have Echo Northwest do a wholesale assessment of the probability of success. They have no conflict. They are not going to be compensated if pension bonds end up coming out of this, and they are not connected with us. But this is the key slide out of their presentation, which is, what is the probability that the PV, which stands for present value, meaning what it's worth in today's dollars, is more than 0. What that means in English is, what is the probability that this bet is going to pay off? We gave them 3 different borrowing rates. One in my world is called the TIC, or the true interest cost. So that's equivalent to the internal rate of return or the APR on a car loan. And I have a cold, so I am going to get a cough drop. 1 second. And we gave them 3 different interest rates: 2.5%, 3.5%, 4.5%. When we gave this to them, this was about 4 months ago, we were pretty close to 2.5% being the actual borrowing rate. We're still south of 3.5, but as I noted on a previous slide, we've been assuming 3.5% on the borrowings. And we also gave them an outer limit of 4.5%. And I have to say, the probability has never been this strong. Having a 95% probability, or even a 90% probability, is way stronger than we've seen in the past. And even at 80%, I mean, does this sound sort of like a coronavirus vaccine test? All of these are almost, certainly, I don't want to say too good to be true, because that sounds like a judgment. They are solid percent benefits. Of course, it is also true, you can look at this the opposite way, that if you've got an 80% probability of success, it also means you have a 20% probability of failure. So that's not nothing. And that's why I think if you go down this path, you just really need to do it with your eyes open, that there is a chance this can go badly. And if that's not scary enough, it's also appropriate to know that there are other risks, one of which West Linn has experienced. So we'll talk about that in a few slides, but one thing that's important to note is that the timing of earnings matter. So it's not just, oh, if I borrow at 3.5, if I earn more than 3.5 over the 20 years, I'm golden. That's mostly true, except that if you borrow at 3.5 and then next year the fund loses, like 27%, it's really hard to crawl out of early negative returns. So that's something to be mindful of. It's also true that your credit against your payroll rate is not going to be consistent. It isn't going to be a flat line where you say, oh, I'm going to get a 10% credit against my payroll percentage each year. Why? Because there is going to be earnings variability. Some years you're going to earn 7, some years you're going to earn 12, some years you may lose money, and that is trued up every 2 years with the valuation that PERS conducts, and it will show up in your payroll rates each time. And there may be some of this going on. It's also true, continuing the gambling lingo, that side accounts cause kind of a doubling down of the investment performance. What do I mean by that? Well, when PERS does poorly, it's not just your side account that is losing money, it's the rest of the overall PERS portfolio. which means that your overall payroll rates will face upward pressure in an environment where the PERS portfolio does poorly. That is exactly the same time that your credit on your side account, which is also losing money, is going to be going down. So at exactly the same time that your overall payroll percentage is going up, your credit is going down, which means that you're going to feel the effect twice. It is also the case that the opposite is true. In good years, in good investment years, the overall fund is going to be doing well, which is going to cause overall rates to go down, and your side account is going to be doing well, which is going to push the credit up. So what do you do about that? Well, creating a reserve in good years is a really, really good idea if you go down this path. One thing that has been notable to West Linn in particular is that if you have strong payroll growth, stronger than what the model assumes, which is 3.5% per year, it will change the timing of when you experience the savings. And I'm gonna just say that and come back to that later because I can show you how that affected you, because you have, over the course of the past 15 years or so, had payroll growth that exceeded this 3.5%. And I'm seeing a lot of questions come in, so let me look at the chat. Okay.
Yeah, this slide was a lot to process. So maybe let's linger here for a little bit and kind of unpack some portions of this.
Okay. Right. So the district does have a side account because you borrowed in 2004. So we're going to look at the performance of the past side account, so you get a sense. And this is a proposal to potentially create a new one. Yes, and they would be placed in the PERS portfolio. So Ginger, it looks like you have another question.
So placing, so let's not call it a side account. If you've been using it as a PERS bond, if we get another PERS bond, it causes doubling down on investment performance in the state's fund.
Yeah.
You're saying? And that means what for us again?
So you know what? I think maybe I'm going to skip ahead and look at your experience, because I think I'm a numbers person, so hopefully this doesn't turn people off, but I think it will help you sort of absorb the points I'm trying to make here, okay? Or Ginger, you have your hand up again. Was there something else you wanted to say before I did this?
I meant to lower it.
Okay. All right. So there are a lot of numbers on here, and I appreciate they may be too small to see clearly, but let's see if we can sort of talk about the broad overview. So the top box is going from the 2007 valuation, and we selected that intentionally because that was the last valuation before the recession, when things were in really good shape. And it goes to the most recent valuation, 17, 18, and 19. It may sound dated, but the 19 valuation is the most recent information we have. It was released in the fall of 2020 because everything from PERS lags. And it is the valuation that is setting your rates, the percentage you pay to PERS with each paycheck starting this July. Okay. And those payroll rates that start July of 21 will run through June 30th of 23. Okay. There is a system overall of the PERS fund, which includes nearly all cities, counties, school districts, community colleges, state agencies in the state of Oregon. And they have a total payroll today of about $11 billion. They also have a fund that consists of all the contributions that each of these agencies have made that is valued at about $80 billion today. School districts are all in a pool together. So from PERS's perspective, you're all one employer. You all pay the same base rate, whether you're a teacher in West Linn or a custodian in Ontario. If you're tier 1, every school district pays the same rate. That is a tried and true insurance pooling way of diversifying the risk from one district to another. You all together have a combined payroll of $3.7 billion. And you also have something called a UAL, which stands for unfunded actuarial liability, which is a lot of words that basically means the shortfall that you have as part of the school district pool to the PERS fund. If it was 100% funded, as of today, there would be nearly $8 billion more in cash in the fund. You are financing this debt with PERS at an assumed rate, which is the rate that's built into the PERS model of 7.2%. Back before the recession, that shortfall, that UAL, was still large at over $1 billion, but was nowhere near as large as it's grown to today. Okay, everybody tracking so far? Let me just pause there. Cool.
Dylan, did you have a question?
Yeah, this chart is making no sense to me. I think the problem for me is that the combined valuation payroll is kind of the starting point for this, and I don't have a clear idea what that is. So the last 3 or 4 minutes have just been kind of a blur for me. So I don't understand what we're building to, and I have a feeling I'm not going to figure it out if I haven't figured out the last 3 or 4 minutes. So that's me being vulnerable.
Well, no, I appreciate that, and you're right. I am building up to something, so let's go back. The payroll arguably is extra noise that you don't need to understand. What you need to understand is this line, which is the UAL. The UAL, as I said before, is the shortfall that school districts as a group have to the PERS system. It's a debt that you have taken a loan out at PERS, and they are charging you 7.2% interest. Does that make sense?
So is that a debt that we owe right now or that we're going to owe in the future?
It is a debt you owe now and that you are already paying for. And let me show you how you're paying for it. So these are percentages of payroll that your district pays to PERS with every paycheck. There is a line item, tier 1, tier 2 UAL rate. You see that?
Mhm.
Back in 2007, 9%, nearly 9% of every paycheck that was sent to PERS was to pay for this $1 billion debt. It's now at 14%. That's not, that's literally a 6% of payroll increase that you are paying, and your payroll right now, according to PERS anyway, is about $60 million.
Mhm. Yeah. Yeah, so Dylan, 60 million, that's the payroll cost per year for the district. And then Carol, when you say 7.8 billion here, and
Right
when
here.
you're coming down to the percentage here, this percentage includes in the, it's like in biennium 1921, the tier 1, tier 2, we have 24.25%, and then 21, 23 is 20.15%. That 14% included, embedded in that, right?
Correct.
Okay, so board member, remember when I share with you the current per rate that we have for biennium 1920 with tier 1, tier 2, we have 24.25%. So remember before when Director Thompson asked about how much it costs the district to pay on all the payroll benefits. And my message is every single dollar we staff earn on their salary, it really costs the district $1.65. And the 65, so when we budget $1 to pay salary, the district have to have $1.65. $1 go to salary, 65 cents go to the benefits. And then this benefits for the group of tier 1, tier 2 in biennium of 1921, 24.25% of that go to support and pay off the per benefits that they have. And then 6% for the district contribution, and then another 7% for Social Security, and then other 1%. So all of the benefits add up is 65%. I think a little bit deep down, but I can go explain a little bit more. I just want you to have the connection between the 14% that Carol talking about.
Right.
Dylan?
So do these numbers mean that if our payroll is $60 million, we're going to pay about $15 million a year towards the PERS debt? Is that about right?
Yes.
Okay.
Yes, because with when I do the budget for last year, we have 60 million. So let's say about 60 million in payroll. Then I have to factor in about 65% of this 60 million for all the payroll benefits. And that within the 65%, 14% go to support tier 1 and tier 2 unfunded liability for PER. And then another 1.69% for tier 3, what is the officer.
Right here.
And so on a practical level, what we're always wrestling with, Dylan, is, we get this money from the state and we think, oh gosh, we can hire so many people, but we have to factor in increasing amount that we have to keep setting aside or paying into PERS, which lowers our ability to then hire more people. So what do you do? You know, that's the question. What can school districts do to get on top of this increasing PERS percentage conundrum? And the state is trying to right the ship a little bit. They realize that Tier 1 in its bylaws created some of this exacerbating cost. Tier 2 came in with some new rules to try and mitigate some of what was happening with Tier 1. OPSERP, which is now how employees are hired under a whole nother retirement kind of, for lack of it, just set of conditions, makes it more manageable for employees, but we still have people in Tier 1 and Tier 2 that we have to take care of. So in the long view, the fewer Tier 1, Tier 2 employees you have and the more OPSERP does get employers to a better place where they can maybe think about how much goes towards salary and how much goes towards retirement, but we're not there yet. We're still in quite a conundrum. And buying these bonds has been a way that districts have taken a gamble, to use Carol's words, to try and get some more cash flow so that it doesn't come all out of your state school fund, out of your budget.
And if I recall correctly, and I'm more asking if this still holds true, but we had been advised previously in years past that we can anticipate this unfunded liability to continue to increase. And I thought it was through 2032-ish. Is that still the expectation, or when do we anticipate it? I think then it was supposed to plateau for a few years before it would go down.
So the latest estimates I've seen are that it is expected to potentially increase. So it is all based on the rate of return that the PERS fund earns. And the reason it jumps so substantially from 2007 to 2019 is exactly that. When you lose 27% instead of your assumption that you've earned somewhere between 7 and 8, obviously it takes a hit. So that causes the debt, the shortfall, to grow. Last year, the last data we had was as of September 2020, when the actuary projected, and this is probably what you saw, that because as of September, the market was still in bad shape last year, that the UAL was going to continue to increase for the next couple of years, and then it was going to finally plateau. Won't go away until 2043, but at least it was expected not to increase anymore. In the past 3 months, so between September and December, the fund actually made money and came in just slightly above the assumption. So my guess is when the actuary updates that information, we may see a plateauing rather than an increase. But a lot of the reason that this grew so dramatically is because we lost a ton of money in 2008, and then the legislature stepped in and kept delaying and delaying and delaying paying it back through various legislative efforts. And, you know, as with any debt, the longer you take to pay it back, the more expensive it gets. So, Ginger, you have your hand up.
So we have a PERS bond right now.
Mm-hmm.
From 2004, we only owe 7 more years on it.
Mm-hmm.
But we're still going to have PERS debt at the end of that bond?
So, two separate things. When you did the 2004 borrowing, so this is now, years before 2007, you were borrowing against the unfunded liability that existed then. This is exactly what I was saying before, though. You're never off the hook with PERS if their performance does not keep up with the model. So by 2008, which I didn't show because I didn't want to overwhelm this, your share of the liability ballooned again. And as part of the overall system approach to delaying, repaying, delaying, your share of the liability has only grown too. So let's look here. Back in 2007, your share, and the way they allocate this is purely pro rata. So your payroll divided by the overall school pool determines what percentage of this number belongs to Linn-Wilsonville. Back in 2007, you had a UAL of about $15 million. But because you had been so successful with your 2004 borrowing, where you borrowed $42 million, we'll come back to this, because you borrowed in 2004 and then 2005, 6, and 7, you had very strong returns. You actually had a side account at the end of 2007 that was worth $8 million more than you had deposited 3 years earlier. So that's the kind of experience that makes you go, yay, this is fantastic, such that by 2007, this negative number means that you were actually in surplus. You had $35 million more in the fund than you needed based upon what the model was saying. That's a good thing because in 2008, you lost nearly all of it. Such that by 2019, your share, even with a $27 million side account still, after 16 years of drawing it down. So this is actually a very strong place to be. You have saved money. You still have a UAL that's almost $110 million. And that is not related to the 2004 bond. That's new debt that the PERS system piled on you. So you are currently paying on $137 million in additional debt that is made better because in 2004, you borrowed some money and you deposited it and generally have done very well. On a percentage of payroll basis, okay, so this is all interesting, but how does it affect your day-to-day operations? PERS divides their percentage into components. The normal cost rate is forward-looking, where if everything went according to their very complicated model, where they feed in rates of return and rates of payroll growth and how many women they have and how many men they have and how many are likely to go out on disability and how many are going to pass on when, et cetera, et cetera. It's very complicated. If this rate was correct, you would never have to pay another dime. That's the forward-looking normal cost. But then there's this UAL, which is backwards looking and is arguably the, oh, our normal cost was wrong because one or multiple assumptions that was built into the model was incorrect. Usually rate of return is where it shows up. So there's an unfunded liability percentage. OPSERP is the new pension program that was started back in 2003 when Tier 1 and Tier 2, as Kathy was saying, was identified to be overly expensive. They came up with a new system that they could have called Tier 3, but for whatever reason, they called it OPSERP. Back in 2007, it was in surplus. It now has a small liability, but it's small. And that leads to a total school pool rate that is paid by all school districts was nearly 14% for Tier 1, Tier 2. Now it's more like 29%. And that's largely because this number has gone up. Actually, the normal cost has also gone up. However, those districts that have a side account get a credit against the payroll rate. Yours was 10% back in 2007, and it has gone down over time as you've drawn it down. This is a rate that is unique to West Linn-Wilsonville, although every school district that has a side account has its own credit. Leads to an overall rate. There are a bunch of other components that are probably not worth wasting your time with today. Back in 2007, you were paying 4% roughly of your payroll. Now you're paying more like 20%. And the good news is that actually, this is the rate you're paying today. It is scheduled in July to go down. So that's helpful. Okay, I know I've barraged you with a ton of numbers here. Should I keep going to show you how you've done with your bond, or are there questions?
So Carol, because this is a 20-year bond that can have variability, some good years, some bad years, the risk is in the, it sounds like, is in those first years.
No.
Biggest risk if you have, because I keep hearing that 27, the crash of, if you have such a turn in the market and a huge risk right at the beginning, no matter how well you do pulling out of that, like the district horror stories you were talking about, is almost impossible. Because we had even 3 years of really good, when we hit that same, the market, the bottom fell out of the market, by, as we're approaching the 20-year mark, we're still coming out with a win, so to speak, on the right side of finances. Because number one, 20 years is a long time to kind of right things, but we had some good years before that the market tanked.
Yes, that is generally a true statement, Kathy, that you are ahead because you had multiple years prior to the crash. There is one caveat, however, that I want to make sure we focus on that I'll come to in a minute, but just to itemize what that looks like. As I said, you borrowed in 2004 about $42 million. You borrowed at a rate that was at that time a very competitive rate, but is about 2% higher than it would be today. You then immediately earned 13%, then 13%, then 15%, which means that by 2008, you had a balance of $50 million. And that's not because you weren't drawing it down. You were drawing down about, on average, $3.5 million a year. Despite that, your investment earnings were so strong that it more than offset that. And then this happened.
Yeah, because there's that 2008 crash. There's the 12 million, almost 13 million.
Right. And you went down to $33 million pretty much overnight. Nevertheless, despite that, you had built such a strong balance that you have saved money every single year, in some cases, a lot of money, $1.5 million and $1.5 million, except for 1 year. Okay, 2. Such that year to date, this is not a guesstimate, this is actual, how much you have reduced your pension costs relative to your debt service costs. You have saved a grand total of $14.5 million. Now, in the world of finance, this is an accurate number, but you also want to know what it's worth to you today in what's called the present value, which takes into account the time value of money. And in that case, you've still saved a ton of money, about $10.5 million on a present value basis. And some of you may remember that when we were looking at refinancing your GO bonds, we talked about the state having a test that used to be in effect, but that they've repealed for a variety of administrative reasons, called the 3% test, where you wanted your present value savings to be at least 3% of the amount you borrowed in order to achieve those savings. On that basis, you're at close to 25% savings, which, if you were only at 3% savings, under no circumstances would you do this, because a GO bond refinancing is a guaranteed deal. This is not guaranteed. But based upon those metrics, this has been a very healthy refinancing that has saved the district money that you have used in your classroom. So there is, however, another chapter that is less positive that we haven't really seen elsewhere, but reflects something else that it's important for you to understand. And I want to go back a slide to talk about payroll. So when PERS assigns your credit, your rate credit on this line, what they are doing every valuation, and they do a valuation every 2 years, and then that sets the rates into the future for the biennium. When they did the 2019 valuation, what they did is they looked at your side account and they said, oh, we have a certain amount of money in the side account, and our goal is to come up with a drawdown over the next 7 years. That means that we're going to end up with 0 at the end. So they come up with a drawdown, and that drawdown uses 2 variables, 2 and only 2. It's not their incredibly complicated model. This is actually a pretty simple model. The two variables they use is that they assume that each and every year from now on, that fund is going to earn 7.2%. That's it, 7.2% every year. The second variable they use is that your payroll is going to grow at 3.5% each and every year. They then assign you a credit percentage. 6.68% is their current estimate that if those two variables ended up being true, that you earn 7.2% through 2027, and that your payroll grew at 3.5% through 2027, you would end up with 0 in your account. However, when they are calculating how much is actually withdrawn from your side account, they are not using a theoretical payroll. They are using your actual payroll. So let's look at what happened to your actual payroll, particularly in the last 5 years. Actually, since 2008, your overall rate of payroll growth has been substantially faster than either the system as a whole or than school districts elsewhere. So what does that mean? It means that your payroll was higher than the model assumed. And when they are figuring out how much to draw down from your side account, they take that percentage credit, in this case, again, 6.68%, and they multiply it times your actual payroll, not this phantom modeled payroll. So every time you grow faster, let's just talk about in 2016 when you grew at 11%, that means that your side account was being drawn down faster than what they were expecting. Which means that when they did their valuation, and you can see this trend line here, each time your side account credit went down. That's because at the end of the day, when they looked at the amount in your side account, they said, oh, we have less money in there than we were expecting. So in order to make sure it lasts till 2027, they've been reducing it and reducing it and reducing it. So what that means is that since you have been drawing your side account faster, you've actually been taking savings earlier than the model suggested you should have. Which means when we project forward, okay, so these are the next 7 years, 8 years, you'll see that all of a sudden it's negative. So we project that your credits will be less than your debt service over the next 7.5 years. This is fiscal year, so it's December of 27, than the cost of your debt service. That does not mean you haven't saved money. You have saved money. It's just that, and this is the starkest example I've seen so far. It just means that you saved more money. You were arguably eating into your seed corn a little bit at the front end faster than you should have. And barring a rate of return higher than 720, we anticipate that your savings overall will go down. So about 11.5 million overall and 9.5 million on a present value basis, which is still hugely positive, but reinforces what I was saying earlier about the volatility that this can introduce into your payroll system. So let me pause. That was a lot, and I have no idea how I'm doing on time. You guys have asked really good questions, and that leads me to yammer. So sorry.
Ginger, did you have a question?
Did we lose her? Okay. So thank you. You did answer my question about the drawdown then. What did we learn from 2008 in terms of government bonds? So how do we learn today? We have a huge federal debt that's only going to increase. What can we learn from that to understand the risk?
Actually, in order to talk about lessons, I'd actually, how much time do I have? Am I way over my time?
We have until 2 o'clock. But we've got, I mean, maybe 20 more minutes for this, and then I might have to revisit this learning.
Okay. Well,
Yeah.
Truly, you guys, I love these questions because I think you are starting to really absorb why this is not an easy decision. But Ginger, if you would bear with me, I want to back up and talk about, and somebody should tell me, is that still the bigger version? Yes, good. Okay, I want to back up and talk about the examples that I skipped, which were some of the lessons learned from 3 other districts that have gone through this. And I have not identified them. One for sure, I'm sure you can figure out. But we have school district A, B, and C, all of whom participated in a pension bond at some point. School District A is my favorite case. They issued twice, once in 2002 and once in 2003 at a rate of 5.6 and 5.73. So again, about 200 basis points higher than where we are right now for borrowing costs. They borrowed nearly $500 million. And after 2002, we went through a period where we had 5 strong years of returns before we hit the cliff of 2008. So that was their experience. School District B also issued twice at much lower interest rates. They actually, the first time, issued a year after you did. And in 2015, they got really solid rate at that point. They borrowed 142 million. They've also done well, but not quite as well as these guys. And then there's School District C, the fact that they still talk to me, you know, I take as a really positive thing. They borrowed in October of 2007. I don't know how well you remember 2008. A lot of us blocked it out. But within a matter of 3 months, they had lost nearly a third of their deposit. So that was fun. Now let's look at their results. School District A, again, 491 million. These were their interest rates. In 2019, same valuation we were just looking at for you. They actually had a side account that was valued after nearly 20 years of drawdowns at more than they deposited originally, such that their savings to date, and they did not have as strong payroll growth as you did, as I said before. I have not seen a case where you are positive, but you've got back years of negatives due to such strong payroll growth. But to date, they've saved $283 million, and we project if they continue to earn on average 720 that they're going to save nearly 200 million more. B, 142 million. They still have 100 million in their side account. They haven't saved as much percentage wise, but they're still in strong case. And then there's C, borrowed in 2007. Their side account is worth about 50% of what they deposited. And to date, not only have they lost 2.4 million, but we project they're going to continue to lose money. This was also a fast payroll growth district. So they made their situation worse by drawing their side account faster. And we project overall that they will have lost $10 million unless the rate of return over the next 7 years is stronger than 720. So what lessons do I take away from that? Well, first of all, you're definitely going to deal with more volatility than if you do nothing. Volatility is not necessarily a good indication of whether you're ahead or behind, but it may put you in squeaky cash flow issues. So if you go down this path, it's a really good idea to set up a reserve, at least in the good years. And what I would say specifically to you guys in terms of lessons learned is if you expect this kind of payroll growth to continue, at least in the short term, it would be better to build your debt around your actual expected payroll growth, meaning front load the debt so that not only are you borrowing at a cheaper rate, because the more you pay earlier, the better off you'll be, but it will be a better match for your actual rate of payroll growth. So we will be working with each district that decides to go ahead, particularly given the SIA and other funds that are available, to actually look at specific payroll expectations rather than just assuming that everybody's going to grow at 3.5%. And in the few minutes I have left, I want to show you the 3 different scenarios we ran for a new potential issue. So maybe not surprisingly, we looked at 3 issues where you would borrow for the full amount. And by the way, you don't have to borrow for the full amount. You could do something less than that. But case 1 is the model case, what PERS uses in their demographics, where you borrow and you earn 7.2% each and every year. What are the results when that happens? Well, if you assume a borrowing rate of 3.5%, I don't even need to do that math. If I borrow at 3.5 and earn 720 every year, I'm like printing money. And in fact, the net rate credit that we expect, or the gross rate credit, is about, and somebody I think has a fair amount of background noise, so I don't know if it's possible for people to mute, but that might help. And Christy, do you want to ask your question now, or should I finish this thought?
You can finish your thought. Yeah. And sorry if that was me, although I don't feel like I have any background noise, but I had forgotten to mute. So I apologize if that was.
No worries. If I've learned anything from a year of Zoom meetings, it's to be a little more Zen-like about technology. It's all good. Anyway, your rate credit would be about 12.8%. And it would be the same every year because we're assuming that you earn 720 every year. Your debt costs would be about 9.75%, which means net net, you would be saving 3 percentage points of your payroll. So that's 3% of $60 million. Overall, savings would be about $51 million. On a present value basis, $36 million. And the percentage savings, that 3% test, would be 10 times that. Okay, so we know that that's not what's going to happen. So let's do two other what if scenarios. The second what if scenario is the scenario that school district A experienced, where immediately after issuing in 2002, they earned 22%, then 13, et cetera, 5 good years, and then lost a ton of money 5 years later. How you doing? Well, not surprisingly, given school districts A's performance, you're actually doing even better than. You would save 5% net of your payroll, or $88 million overall. Again, do I think that's going to happen? No, nothing that is on this paper is exactly what you are going to experience. But to give you the range of what if scenarios that seem reasonable, we also ran what to date has been our worst case. Is this the very worst case? No, I could throw in all kinds of terrible assumptions about market performance that will make this, that would be way worse. But this is the, what if I borrow and immediately 3 months from now, I lose 27%. And then I have exactly the same returns that those who borrowed in 2007 did. Well, shockingly, and I've been doing this for a long time, this has never been the case. Even then, you're saving money. On average, 1.25% of payroll. Now, a legitimate question would be, well, how is it that school district C is never climbing out of their hole? The fundamental difference is that school district C borrowed at 5.67%. Whereas right now, even if you had those horrific circumstances, you're looking at locking in a borrowing rate that is substantially lower. So, okay, Christy, I've made you wait for an extended period, so go for it.
No, that is fine. And again, I'm going to be talking out of my husband's mouth. So, these are just the kind of things that he throws out. So, we see that it's a good time to borrow, that it's 3.5%, that's a good interest rate. Mm-hmm. The question is it a good time to be going through arbitrage or investing in a stock market? Mm-hmm. In his mind, where he says that he feels like the stock market is hitting an all-time high, and that some of that is because of a 2.5 trillion in stimulus that has been poured into the market. Again, those are his words, not mine, that has been poured into the market in the last 12 months. And so the question is, okay, well, we know, we feel good about this interest rate, but what about the fact that the market is at the top and what we might expect? Now, again, I understand it can keep going up, or so I guess what I'd like you to do is speak to that, of course, knowing that we never know. And then also speak to would it make sense? And it looked like some school districts had done this, to do half now and half at some point in the future, just based on that fact that maybe right now is a little bit more risky because of where we see the market at.
So all good questions. You should tell your husband, thank you for loading you up with them.
Oh, he loves this stuff. He was so excited. I mean, we went through it twice. He was so excited.
That's awesome. And I would be almost happy to talk directly with him. So I think that's the key question. I don't know if we're at the top of the stock market. This is why, getting back to what Ginger was asking earlier, I don't give recommendations because I don't know. That is not my area of expertise. What I can tell you is that interest rates are at all-time lows. What I can tell you is that Echo Northwest did an assessment and came to the conclusion that at these interest rates, your probability of success was high, even if the stock market is at all-time highs. And what I can also tell you is that if you lose 27%, so let's say it is at all-time highs, and we go through a loss, usually what has happened historically is that the market then recovers pretty fast. If that's the trajectory, even so, you save money. Now, could it be a very anxiety producing period if we lose 27%? Believe me, I lived through it once. It gives me heartburn just to think about it. Do I think that's likely to happen? I kind of doubt it. You know, I think the stimulus package is propping up the markets. I think it will likely continue to do so for a year or so. After that, don't know, but certainly the last recession was the absolute worst that we had since 1929. So what are the odds it's going to happen again that way? I'm not an expert. Seems low to me.
All right, board, we have about 7 minutes and then we'll start to wrap this up. Ginger, I see you typed out a question. I was just going to see if Dylan had a question as well.
I see Ginger's question, so not hearing anything from Dylan. Ginger, you asked about the credit rating. Also, you guys ask really thoughtful questions. Thank you. Actually, what we have been seeing from the rating agencies is they consider this $113 million to be your debt. And they have been looking more favorably towards those who have side accounts where it has worked out well. Okay, so that's, you know, kind of the $64,000 question, right? You know, if you have a side account that doesn't work out well, then the rating agencies are looking at your overall debt. But for those that have done well, it has actually been a credit positive. And for those who have done nothing, it's been credit neutral because they look at this debt as your debt, whether you finance it or you finance it through the bank of PERS. And there's my dog. So I don't think I have much else. This is the detail that shows you 720, which shows you a rate credit that's the same every year. This is the detail that shows you the strong rate of return. And the one thing I want to share is, wow, look at the variability. This is the detail that shows you the not so great. And then variability. I will note that there are 2 years that are negative, but they're practically break even. Finally, if you want to do this, Sunlee should notify us and the bond attorney if you want a resolution by next Monday. You also get to specify the maximum borrowing rate that you're comfortable with. So if you're comfortable at 2.5, can put that in. Chances are we're not going to be doing it because I don't anticipate the market is going to go back there. Could. You could put in 3.5. You've seen what the numbers are. Most districts we're working with are putting in something above 3.5. Some are putting 4, some are putting 4.5, but it's completely up to you. We ask for you to adopt the resolution in April, but do note that you are not obligated to go forward until right before the bond sale, which we anticipate being the end of June. So you've got lots of off ramps if you decide you don't want to do this. I would say that by your April board meeting, you should be pretty sure you do want to do this. While I'm not going to force anybody to go forward if they're uncomfortable, you're going to put your staff through a fair amount of work. And if you really think you don't want to do this, then it's probably better not to adopt the resolution rather than adopt the resolution and say, well, I'll see how it goes and I'll back out at the last minute. There is a small cost. You have to request an analysis from PERS at a cost of about $1,250. And I will note, I think I said this, Christy, but maybe not. If you wanted to do a portion, that is absolutely your prerogative. So that's an option too. And now I'm going to shut up because I've used all of your time and give a final rundown for questions. Here is my contact information if you think of something afterwards. So
Thank you, Carol. Thank you so much. Especially the density of this information, along with the specificity, financial specificity of these types of transactions. I appreciate you and your ability to make it really understandable. And when we don't understand, to slow down, go back and help us understand. Thank you. Dr. Ludwig, my next question is more for you, as in how we as a board, I don't believe right now in this moment necessarily we as a board have time to process this in the next 10 minutes and find out our next steps. So what would be, or what do you advise as the best method for us to work through this?
Well, we've got a short runway if you decide you want to alert Piper Sandler to begin the process. We have to alert them by March 22nd. We have this week, this working week, to get anybody else into a meeting for you. If you'd like to now talk to our financial consultant, we can arrange that, and you could have a special session with.
And I'm sorry, Kathy, to interrupt, just to take some of the pressure off.
Yeah.
What we need to know by next Monday is whether or not you want a resolution for your April board meeting. We do not need a decision until your April board meeting. So if you wanted to engage your municipal advisor to come and talk to you, it absolutely does not have to happen this week. Okay.
So what sentence do you need to hear from us by March 22nd? It needs to sound like what?
It needs to sound like we are willing to take it to the next step of having formal board consideration, and we need a resolution. And you can choose not to adopt the resolution or to vote it down at that time.
At our April 5th meeting.
Correct.
Okay, that's okay. When you say we need a resolution by March 22nd, I thought you meant you need the board to produce a
No.
resolution.
No.
The Hogan, that is the law firm, will work with me if they will express interest going forward. Then I will work with the Hogan law firm on the resolution, and it will take them some time. So if on April 5th and you say, yes, we want resolution, I think they need time. They need more time prior to that.
Correct. So if you want a resolution for your April 5th board meeting, then you need to let us know by March 22nd. But there is no obligation to say by March 22nd, I know I want to do this. We just need, as Sunli was saying, we just need some time to prepare the resolution.
Okay.
So what does it mean in your steps to financing? It says by April 23rd, adopt the resolution.
So the working assumption was that we would give districts, since we had our workshop at the beginning of March, we would give till the end of March, March 22nd, since spring break is happening, to talk about the issue, start the education process, and then we would give you your April board meeting to make a decision.
Oh, so this was just general, not knowing when school boards have board meetings. This is a general
Correct.
timeline, not specific to us.
Correct.
So we could have a work session on April 19th. We could actually do our resolution on the 19th.
You could.
Okay. Got it.
Okay. All right. So, okay.
But you need the.
We as a board, I think there's two things that needs to happen a little bit is like, one, our district has, if I recall correctly, at our last, I think, board meeting or work session. So in the last two meetings, there was a recommendation that we consider a PERS liability bond or PERS bond, and that we would, and the board said, well, we'd like a learning opportunity. And so today is part of that learning opportunity. I think the next part the board needs is what is the district's recommendation as far as, are we still on moving forward with interest in this bond? What is the amount of the bond? What is the percentage rate that we would accept on the bond that the district would recommend to us? As well as I think probably a little bit of information on our district's theories around employment growth and potentially how, okay, I'm seeing nods of heads as I'm saying these and how that would factor in.
Sorry to interrupt again. The employment growth stuff is something that we would work on much closer to the bond sale itself. We don't need a decision from the board. The primary thing is that in your April meetings, either the 5th or the 19th, if you want to proceed with this group pooled financing, we need an adoption of a resolution. And in order for us to prepare the resolution, it's actually the bond attorney who prepares it. We need to know by Monday that you want to at least get to that step.
Okay.
Okay.
And just by a rough consent of the board, just kind of gauging who has interest in having a resolution prepared. So I'm seeing Ginger and Christy nod yes, Dylan yes, and I'm also okay. So at this point, that decision has been made, I believe sufficiently, Dr. Ludwig, to direct our district to have that resolution prepared. And then we will continue to work through between now and at least our April 19th work session, what it is the board needs to best process that resolution. Yes, okay. All right.
So I'll just wait to hear from you, Reagan. Maybe we can query the board if you'd like opportunity to speak to with our financial advisor.
Okay. And I think,
maybe
yeah, that would
make
be
that
a part. Okay, perfect. We'll work on that. So then board, I know Christy is going to leave us here at promptly at 2 o'clock.
Can I make a motion?
Yes.
I move that the board pass resolution 2020-20.
Is there a second? I will second. There it is. Moved, seconded, and discussion. And I think Kurt, just in a nutshell, can you please tell us what the great part about this E-rates bond is?
Yeah, so E-rate, the short version is E-rate's a federal program that was instituted 15 plus years ago that was designed for helping schools get online. It's evolved over the years, but at the end of the day, what the big selling point of E-rate is that we either get reduced prices and or rebates on purchases that we run through the E-rate program. In this case, it's a 40% rebate that we stand to be eligible for. So whatever we spend in a few months, when we can show that the project is complete, we'll get a check for 40% of that back. And there is a little bit of a timeline involved, which was why we had to try to get this on the agenda today, or at least this week. So that's the short version. I can answer any additional questions you might have.
Any further questions or concerns? All right, seeing none, Kelly, could you please call it for a vote?
Certainly. Regan Molitor,
Yes.
Ginger Fitch,
Yes.
Dylan Hides,
Aye.
Christy Thompson.
Aye.
4-0, resolution passes. Thank you.
Thank you very much.
Thank you,
Appreciate it.
board. Yeah, thank you, board, so much being flexible in the handling of this and its time frame. And the only other thing I want to add is I forgot to mention public input prior to the start of this meeting. And I just want to confirm for the record that we actually did not receive any public input for the meeting today. With that, thank you everyone for giving us this time in the middle of your workday. And Carol, do you have one more comment?
I have one more comment that Sunli asked me to make earlier and I completely forgot. Financial advisor. I think having a financial advisor is an excellent idea, particularly for this potential idea. The program may have a line on a financial. So long story short, you can hire whoever you want. One of the participants in the pool, LeGrand, volunteered to get in touch with a financial advisor to see if he could get a program fee that would be less expensive than each district hiring their own. He got a fee quote from a financial advisor who is very well regarded, but is not the same financial advisor that you have worked with in the past. Again, I am neutral on this subject. I think they're both good, but that's a decision you will need to make as well. And that's all I had.
All right, thank you. And
Thank you, Carol.
we'll
Thanks,
conclude.
Brendan.
Yes, thank you. This special meeting, and board, if you could just hang on for a quick second.
Okay. Nice seeing all of you. Let me know if you have any follow-up questions.
Thank you, Carol. Thank you, Brendan.
You're welcome. Bye.
I am stopping the recording of the regular session, special session.